Right now to talk about talk all about this is PIMCO's Mark Kiesel. He manages the $6 billion investment-grade corporate bond fund and the $1.8 billion PIMCO long-term credit fund. His new report out is called Sunlight on U.S. banks, and paints a picture of the risk and opportunities PIMCO sees in the financial sector right now. I had to take a breath there, Mark, but good to have you here with us. I should point out it's one of the most read stories on the Bloomberg terminal, so this report that you've put out has really caught the attention of Wall Street today. What makes you feel confident that U.S. banks have kind of turned the corner here? Because there's still a lot of questions out there. We're seeing firing, there's concerns about the regulatory environment and so on, but what makes you feel more confident here?
Well, there's a lot of dark clouds, but it's more of a headwind for equity than for bondholders. The fact is that asset quality actually turned positive 5 quarters ago. The banks have doubled their Tier 1 capital in 8 quarters. It's a sector that really is hated by the equity community as well as the bond community, and the valuations have been very attractive. So we like looking at the contrarian view here, and I think there's a lot of upside in bank bonds.
I like contrarian views as well, Mark. Give me an idea of what you guys have been buying specifically.
Well, basically, major U.S. firms like J.P. Morgan and Goldman Sachs, these companies are basically pretty insulated from Greece and from the European crisis. They don't have the same litigation concerns or punishment that Bank of America did because of its acquisition of Countrywide. And quite frankly, they have the best liquidity and capital position of the major brokers and banks in the United States. So what's happening is that you're going to have to go under new capital and liquidity requirements under Basel III. These companies are almost there, and that's going to be phased in over years. So they're going to stand out as clear winners in the industry.
Hey, Mark, let me ask you about concerns that regulation has toughened up so much it's made it impossible for these guys to make money. I mean, we're talking about a revenue loss of $20 billion in the first half this year compared to last year. Does that not bother you?
Well, I think that's a great point because we've been so focused on punishment, but we're going to transition from punishment and penalties to making these banks safer under regulation. I think basically you're looking at an earnings hit, not a capital hit. In fact, capital has been building, which is making the bank safer and making bondholders in a better position in the capital structure. The fact is that the big four in the United States throw off $140 billion pre-tax, pre-provision earnings. So these penalties literally are a quarter or two of earnings, and this is something that the banks can grow out of.
You know, you make a good point because we focus often a lot on the equity side, and we know that the margins are going to get squeezed at banks. They're having a hard time making loans. The regulatory environment is going to impact them in their business. But again, you say higher capital positions, it's better protection, correct? And so from a bond side, a fixed income side, it makes them stronger players here, right?
Yeah, I mean, if you look globally around the world, the fact is that the U.S. banks are among the most profitable in the world. You have 4% net interest margins. Because the U.S. banking system was able to get capital from the government 2 years ago through the TARP and also repay it, the capital has rebuilt. We're in a much stronger position in the United States than some of the European financials. So I think we're turning, and I think investors will move into this sector, particularly in the debt side.
Just to be clear, though, Mark, you're not going to go so contrarian and so risk-on that you like Bank America, right? Because you talked about the litigation risk. They might not be out of the woods there yet, and people are saying they're the ones with the biggest challenges to actually raising what could be Basel capital rules.
Right, and we are more positive on companies like J.P. Morgan and Goldman. To put this into perspective, we've done a lot of internal research on this, and we have 38 analysts and 7 just dedicated to financials. And J.P. Morgan and Goldman can literally get to Basel III by the end of 2012. Most banks are going to take until the mid, say, 3, 4, 5 years. Bank of America organically could take 3 or 4. They're ultimately going to have to, I think, divest their investment in China Construction Bank. So Bank of America, of the major banks, is in the least best position from a capital standpoint. Again, Goldman Sachs, J.P. Morgan look very good. They have great capital, great liquidity.
Hey, just quickly, you know, you were speaking of reform. Earlier we talked to Bloomberg contributing editor and author of House of Cards, Bill Cohen, about the effect of financial reform last hour. Let me just play that for everybody. Listen up.
I think there's no question that, after, the crisis sort of settled down and people got a sense that things were going to be better in 2009 and 2010, Wall Street ramped up the hiring. But now, with the full effects of the Dodd-Frank law still to be felt, and the fact that just business is slowing down in general, out come the long knives.
And Mark, we were specifically talking about that we're seeing a lot of Wall Street firms letting go of workers. I mean, that you see those kind of moves, that's not something that worries you.
No, I mean, the banks are in a position to be able to manage their expenses, and compensation as a percent of overall revenue is coming down. I think the fact is that the housing crisis is about 80% done. And what we're doing is we're paying for past sins. What you have to really do as an investor is look forward. And in looking forward, the capital position is building organically in these companies. You're making bondholders safer. So it's an earnings issue. It's not a capital issue. It's a headwind for equity. It's a positive for debt.
Yeah, definitely two markets playing out there on this one. Hey, Mark, thank you so much. We appreciate it.
Thank you.
Mark Kiesel over at PIMCO.